Well, I appreciate the chance to speak with you. I'm Dan O'Brien with Kansas State University Agricultural Economics, and Guy Allens with Kansas State University IGP International Grains Program. And we have some comments on international grain market trends, and want to build upon, help support what Antonina has just talked about in terms of the impact of geopolitical conflicts. So, okay, let's see here. Guy, would you like to home in on these first few comments?
Yeah, the first couple comments here. Thanks, Dan. Look, I think we're coming up on a bit of a critical time here, May going forward on this summer, on how this potential conflict might resolve itself one way or the other. So we're getting the market, I think, is increasingly paying closer attention to that. Thus far, having that grain corridor open has gone a significant ways to supply a significant volume of grain in a critical demand area of the world, in an environment where we have very tight global stocks of both wheat, corn, and oilseeds as well. Hopefully the situation will become resolved in the next few months. I think, though, even if the fighting stopped today, it's going to take 10 to 15 years or longer to rebuild that capacity that we have seen in the Ukraine and bring it back to any sense of normalcy. And that's what we're sort of hoping for. It's going to be interesting how this proceeds, and we're watching that pretty close. Did you want to add anything into that, Dan? Or
no, go on to
okay,
your thoughts on China-Taiwan.
Yeah, China-Taiwan is actually a situation that concerns me to a greater extent and in significantly different ways than the Russian-Ukrainian situation. Basically because China is a significant buyer of global commodities across the board, from wheat, coarse grains, and oilseeds. Now, they continue to rattle their sabers on the Taiwan situation and make it a political issue. That said, we continue to see China be a growing buyer of agricultural commodities in the grains and the oilseeds, in the meat products, and in fiber there as well. And I'd like to think that that trade relationship and that demand for food and fiber is going to make that Taiwan situation take a significant back seat. Also, China's increasingly seeing some domestic economic turmoil, driven by the property bubble situation there, as property market and property investments have collapsed in recent months. That's making state-owned banks holding debt pretty worthless, as that has dropped out. A lot of those situations, and this is in the wake of COVID, and a lot of those situations has been put back to the provincial governments to manage those situations, particularly the pandemic. Moving forward post-pandemic, China has effectively lifted all those bans and restrictions in relation to COVID, and that's going to have significant impact on the economy as we see that start to recover. And this is in the wake of what I would suggest we've seen a significant exit of supply chains out of China into other areas. So we'll watch that pretty closely and its impact on commodity demand.
I just would add in that the shaking of confidence economically around the globe that would follow from this, fears of what could come out of it would affect broad base of markets, economic, financial, and the U.S. grain livestock, grains in particular. China is a major buyer of soybeans, had been a major buyer. They're sort of in and out. They're still the largest percentage buyer by far of grain sorghum. They're involved in the wheat, corn markets, and those you have markets affected directly or indirectly. So it's large issue. Really not pricing that into anything right now, but it's sort of a worry that's out there. Guy, you want to continue and talk about some of the Fed Fed funds issues.
Yeah, before we drill down into each of the commodity complexes of wheat, coarse grains, and oilseeds, sort of wanted to talk about some bigger macro drivers. One is the U.S. dollar and the exchange rate situation. The value of the U.S. dollar in the index has come off in the last 4 to 5 months quite notably. The big driver of that U.S. dollar index is the euro specifically, and secondary is the Japanese yen. The biggest buyers of ag commodities though are other countries. Now, what's driving that is the rapid increase we've seen in U.S. dollar interest rates. Every time the Fed raises the interest rates, it makes the U.S. dollar more attractive compared to other currencies around the world, and the response is an increasing in proportional interest rates and a lot of other currencies there as well. But we're seeing a significant change in distortion of that, and this is just showing the rapid rise that we've seen in interest rates. We're back to GFC sort of levels around that 2007-8 situation, and that's having an impact on trade flows. Pull up the next slide there. This is sort of the U.S. dollar index, and as I said, it's come down since the levels we saw late last year to 101. What I have there on the left-hand side are some particular currencies that are more important to the commodity trade and how we've seen those change in the last week, as well as compared to a year ago and the change year on year. Now, those are generally up for those particular commodities, and that's having an impact on trade. Still has U.S. commodities not only expensive in the absolute dollar sense, but also increasingly so expensive for major buyers as well as competing exporters. Case in point, it's making Brazilian and Argentine and even Canadian product a lot more competitive than U.S. product.
The move by the BRIC countries to secure a stronger position in the currency and world currencies is interesting, but that's beyond myself, at least, to talk about in an informed manner, but interesting to see how that could impact U.S. currencies and agricultural trade down the road.
Yeah, just a quick comment on that. I think that expression is an increased frustration and not liking the fact that the U.S. dollar is the world reserve currency. However, I struggle to see how that can change too quickly. I don't see the Chinese yuan becoming the global reserve currency just because it's not a normalized currency, and the Chinese government's frequent using that exchange rate. It's not a market-driven exchange rate. It's set by the Chinese government on that. So I think that's more of an expression of frustration with the current situation than the possibility of that happening too quick.
Go ahead and talk about the Illinois River barge freight issue.
Just on transportation issues, look, it's still fresh in our minds, the high barge freight that we saw last fall during the peak harvest season. This was due to low water in the lower Mississippi River, and that was a result of the dry weather we saw in the western plains area and water flows coming down the Missouri and other western rivers into that. Since that time, we've seen the river recover to more navigable levels. The one caution I'd put there, it's still dry in the west, even though we do have fairly significant snowfalls and winter snow melts that are charging that center, the river, particularly from the northern Missouri. It does leave a concern for later in the year as we get into later summer and next fall, potentially having transportation issues on that lower river, particularly south of St. Louis, and just keep that in mind. More to the global ocean freights. Global ocean freights have come down this year from where we were in late 2021. We're probably down to more nominal levels, not quite pre-COVID levels. And this is because of higher energy prices and fuel prices, but they seem to be stabilizing at the moment around that 1,400 to 1,500 index levels. what I also have on here is sort of the nominal major route rates on dollars per metric tons. This drop in stability is helping U.S. competitiveness in the world markets, particularly on grain coming out of the Black Sea, and particularly for wheat coming out of Australia, where they hold a transportation comparative advantage into those high dollar value markets of China and Southeast Asia, Japan.
Yeah, this may be helping, but the value of the currency, US dollar, is working the other direction generally. So
yes,
interesting.
Exactly.
We want to look at some perspectives on the grain markets, especially international grain market trends, and historically overall, you stand back and look at the numbers, and we still are at historically tight levels for global corn, wheat, and oilseed stocks. Following, again, 3 years of disruptive La Nina weather patterns affecting some major crop production areas, we are looking at still are dealing with drought in Argentina. Given following on what Antonina had talked about, still expecting, have seen some of year one smaller crops and exports from Ukraine anticipate the challenges going forward as they rebuild and hopefully move out of a war-torn conflict situation. And I think overall, there's expected emergence of an El Nino weather pattern that would be more favorable to at least North American crops, some differences around the world than we have been seeing. And I think if there's a narrative attitude of the markets, is that, hey, we're shifting out of the La Nina to El Nino. We expect more moisture come this summer. And I think as you look at the recent trends in grain futures, that seems to me to be an issue in play. We do have, out of the latest El Nino information from the U.S. government, statements such as this at the bottom of the recent weather publication that came out. And so neutral conditions expected to continue through the northern hemisphere spring, followed by a 62% chance of El Nino developing May through July of 2023. You see a statement such as this: current and forecast status of El Nino. El Nino conditions are present. There's a greater than 90% chance of El Nino will continue through the upcoming winter. So with that in mind, then forecast maps like this they come into play in terms of how market analysts, how market participants view the prospects for this coming year. Again, precipitation outlook for June and August. You see green being near average, more to the southeast, more above average, moving to above average, still dry in the west to some degree. So I think the market is taking this as their narrative belief and their expectation. I don't want to belittle that, because this is the latest information, but it does seem to play into where this is at. Guy, this is something that you'd brought to bear, and would you want to talk through this?
Yeah, just I like to remind everyone, situations in the U.S. are sometimes quite opposite elsewhere. We could see the current La Nina situation that we're supposedly coming out of. It highlights it's dry in the U.S., particularly in the southern part of the U.S., and it's dry in Argentina, where in other places in the world, particularly Australia, Southeast Asia, it's wet. And as a result of that, we've seen Australia, with 3 years of La Nina, have 3 years of record wheat production down there. And that's those exports are what we're competing with, both in wheat as well as grain sorghum, into those Southeast Asia markets.
But this is where we're going, and again, the expectation.
Yeah, this is where we're going, and it's drier weather, particularly in Australia and Southeast Asia, where in the U.S. it's notably wetter. Now, if your perspective is Kansas, you're going to say, well, we're not there yet. No, we're not. Australia isn't dry yet. They're having a good start to the planting time for their wheat and barley crops, their winter crops at the moment. So I think it takes a bit of time for that to transition through. But it's the El Nino situation, particularly the deep El Nino situation, that will put Australia, Southern Africa, and parts of the Asia subcontinent back into a drought situation.
And South America, dry and wet changes places. In essence, drier now into parts of to the northern areas of Brazil and Argentina in terms of production, a little wetter to the south. If you go back and look, that was just the opposite of where we were before, and that has played out this year in terms of the cropping situation.
It's still quite dry there in Argentina, so they're sort of looking at the world similarly to Kansas. El Nino is supposed to be wet, but it's looking still very dry down there.
And you can see on the latest crop moisture maps, this taken on Monday, see our current situation. As you see the North American dryness as it stands, the dryness in Argentina, spottiness in Brazil, generally pretty good production. Again, you see what's in Europe at this time, not dry in France, Germany, et cetera, some places where it had been quite dry. Some dryness in South Africa. India thought to be pretty wet at this point. Note that India's, as we would move to El Nino, El Nino cycle would be thought to be much drier. Some spottiness in Argentina, in China, but again, generally wet now in Australia. But as we move to a full-blown La Nina, that would switch around.
Yeah, just a note there on India. Dan, they have restricted their wheat exports at this point in time, and so and keep in mind, India is the largest producer of wheat in the world on that, and so that's starting to have implications for global trade. And then just highlighting the Argentines and Paraguayan situation, that it's been quite dry. And then North Africa, that's a concern from a number of
Morocco, those areas, big importers. Okay. So it's moving on. Overall prospects for 2023 crop markets. U.S. crop prices generally supported at moderate to high levels. Emphasis here of late from Kansas farmers' view at the moderate, but generally moderate to high levels compared to where we've been historically, until the time when grain markets become all that much more confident of large crops and rebuilding of stocks. And part of that expectation is what we see coming out of Brazil. But they've have a large soybean crop, not fears yet of problems with their second safrinha corn crop. So when do we get to the place where we have confidence of larger crops, rebuilding of stocks? And if that happens, then it's a well-told tale for crop market watchers. Then the risk to grain sellers is that farmers, anyway, from that perspective, is that crop markets will mostly discount the possibility of short crops. And if U.S. and foreign crop prospects are okay to good, then we begin the slide into fall 23. Actually, in the last several years, some of our lowest prices have come in early September, where we've kind of bottomed out and transitioned apparently from a focus on production to a focus on use. So interesting to watch that. What to anticipate this year, I would say, of course, we're so data driven now that we have a May 12th USDA WASDE report coming up, and the numbers coming out of that will be important. What's important this year especially is that the May report, it will be the first trotting out by the World Ag Outlook Board in their WASDE report, World Ag Supply Demand Estimates of the 2023-24 marketing year numbers on that, and strenuous discussions about what type of a U.S. corn yield or U.S. soybean yield will put on there and put in those supply demand estimates, and very, very thought provoking. There's also USDA acreage report at the end of June that will have important numbers. We have delayed planting up in the northern plains that could affect corn, could affect spring wheat acres, all that much more. Could have a could push us towards soybeans. So we shall see. But the acreage report is a time could potentially have bring about a lot of volatility or pardon me, could be a volatile time in the grain markets. And just want to, this is probably more a case of living out here in the Western Corn Belt. If it would seem to me that unless we have enough compensatory moisture to change the soil profile situation in the West, that we could be looking at another situation where if the rest of the Corn Belt generally looks pretty good, and that's what the futures markets tend to see, we could have a moderation to even some weakness in the futures, but to have local basis in the West still be quite strong. And that was a situation we had last year. So if that's the case, then summer demand out in the Western Corn Belt for crop supplies by ethanol plants, livestock feeders, you name it, would all come into play again. And in what we would call a highly unscientific, uneconomic term, users would be scrambling as they did last year. So we shall see. But we want to get into some specifics the time we have left to look at some of these markets and guys. So we'll move kind of quickly through these key trends in global coarse grains. Just lay these out first, and I'll take a first pass through, Guy. Then you come back at them if you like. Generally, tight corn ending stocks and stocks to use in the current marketing year, and we'll have low beginning stocks, uncertain crop prospects heading into next year, and an still an at-risk 2023 Brazilian second corn crop. It was planted late, so there's some proportion of that crop is 20 or more percent that because of the lateness of planting will be vulnerable to late season hot dry weather that could impact crop development. I generally don't. I think that the market is assuming this is a non-issue, but it's an issue that could come into play in the next 30, 60 days plus. The market anticipates a normal 23 U.S. corn crop with moisture coming from an emerging El Nino weather pattern, but we're still at risk. Guy, thoughts?
Yeah, not really much to add on that. I think we'll see some key things here. I'll add as we drill down here a bit in that coarse grains complex. So.
Okay. I do think that in looking at CME corn futures, it's a weekly chart. We have since basically last fall, we've been moving in kind of an up and down manner, lower. This is probably just the old economist that took too many econometrics classes. I see low standard deviation, low volatility since that time. There hasn't been any factor that's come in that has shaken the market or had it think anything else than, hey, we have good crops coming, that we won't have any disruptions. And we have had other times where we've seen low volatility, but we're certainly in a time where we're carrying forth without a lot of change or a lot of worries. And if I think that's tied in with the idea that, hey, moisture's coming, we are not seeing any other major problems. So that's just an editorial comment on my own thoughts.
Just to add a point on that, Dan, is we're really not seeing much of a risk premium in that market, whether it's a weather premium or not, even though it's dry in Kansas and sort of the southwestern grain belt. We really don't see a volatility risk premium in this market yet, but I think we could easily see that build as we go forward.
We're coming into the time when if there are worries about production issues, that May, June, July, early July would be a lot of times when they show up. So that's my own cautious viewpoint. Ending stocks, world corn supply demand numbers. Just Guy, you and I have talked. We certainly have increases in production, and note this set of numbers only goes through this chart through the current marketing year. We'll see what the 23-24 marketing year has coming out of the May report. And but with that, current numbers, we're hanging around a situation where we haven't around 293. 295, 307 million metric tons ending stocks on the world side. 21-22 is a 9-year low, and we're just about at that. But from a world less China view, again, ending stocks, note them. Well, we'll talk about that in a second. Ending stocks, 88 million. If you exclude China's stocks out of this, 10.25, 10.25% stocks to use, 10.14 stocks to use is a 10-year low. So we're basically hanging around longer term lows. And, we hang on news with bated breath of the next major crop that comes along. And that's what we're doing right now in watching with the Brazilian safrinha crop. And just note here these longer term trends in terms of world stocks to use, world less China corn stocks to use, and certainly the bottom line down in here, if you can see my pointer, from 129 million metric tons carry out down to 87, 88, the last 2 out of the last 3 years, 10.1, 10.2% stocks to use. It's probably too bold to say that we're at a level that the world does not want to go much lower than, but we've trended down, and we seem to be loath to go much lower than this when you look at world minus China.
Yeah, the key area, well, we're showing it here. Go ahead to the next slide. There is where we've seen the market, particularly for U.S. ending stocks and world stocks, is ration. That is in the U.S. exports for corn, and it's been quite slow and disappointing this year. And it's done a reasonable job of actually seeing ending stocks now finish at a less precarious level than what we initially anticipated.
In the upper right-hand corner, you see the last 3 completed marketing years, 2019, 20 through 21, 22, and then this current marketing year, 22, 23. And you've got some shifting around that's happened. Note that over the last 3 years, there was a drought in there, et cetera, but Brazil averaging about 34.8 million metric tons over the last 3 years with some ups and downs. This year projected at 50. From 19% to 29%. U.S. still down somewhat with our drought that we'd had. Argentina, the last 3 completed years, 37.2 million metric tons, 20% of the world. This year they're down to 25 as for this marketing year that we're in, and 15%. So some real shifting around of world exporting countries. And Guy, would you want to? I know you've noted this earlier when you and I talked about what's happening with China in terms of corn imports.
Yeah, look, China is moved up to, they're the number 1 importer of world corn these days, and the Europeans have, China's in the mix in number 2. Europe's in there with some dry weather, have increased their corn imports there as well. Mexico is definitely on the radar, just given some trade issues there and their position on GMO. It's going to be interesting, particularly on that relationship with China, how that moves forward, whether they put that in place. I know they're getting significant pushback, not only from the U.S., but Brazil, Argentina, and other corn exporters in the world.
Yeah, we could have a whole session on that one, but let's move on. Brazil, note when you lay Brazil and Argentina against one another, it's sort of a horse race between what the USDA is saying, what the market's expecting for a strong Brazilian corn crop this year. You know, at that 125 million metric ton crop size in the last 2 years of higher exports, and Argentina, of course, suffering from drought. The last 2 to 3 years diving down pretty strongly. Any comments, Guy?
Just they've sort of swapped their what was coming out of Argentina is now coming out of Brazil's situation. So they've just sort of, that supply's just shifted from Argentina to Brazil.
And welcome to the El Nino story that we're in.
Yep.
Ukraine and China. I think, Antonina, if you're on, the latest USDA numbers look like this. It's interesting to me that we were at 36 million metric tons of production. 18-19 dove down a little bit, moved lower in 2021, had a strong year in 21-22, and then the war happened. And you're back down now at 27, the latest USDA numbers anyway, to where you were back in 14, 15, et cetera. But exports are higher now. So, and I know the stocks are moving lower. And I think those are consistent with your numbers. What's going to be really interesting, again, coming out of the May report, what the USDA will project now for Ukraine, the 23-24 marketing year. That'll be the challenge. Guy, you're kind of the resident China expert. Would you like to comment on the China corn supply?
Look, they've had increased domestic production there. Also, we're starting to see some recovery in their domestic demand in the swine, as the swine herd sort of stabilizes itself. The other thing I'd sort of add, bigger picture, is the whole livestock sector is sort of what's been rationing that demand, as animal numbers, particularly on the cattle and pork side of things, have well, on the cattle side, beef cattle side of things, have declined notably. That's just where they are in the cattle cycle, in the beef cycle.
Their increases in production have sort of offset the amount that they had been buying on the exports, on the import side.
Correct.
Just wanted to show this from a world coarse grain, a world less China coarse grain situation, going from corn into sorghum, into millet, into oats, and other coarse grains. A pretty similar situation, if anything, a little more dire, actually. Ending stocks for world coarse grains minus China at 10-year lows. The stocks number, the stocks to use number in 2021 is at a 17-year low. So
you add in those other commodities of barley and sorghum, particularly, it shows that things are tied across the whole coarse grains complex.
Yeah, so we are confident. The world is confident right now of the coming second corn crop in Brazil, and they need that thing to come. But there's some risk in that confidence. That what if this thing doesn't happen? So we're sort of I guess we're sort of on the edge in terms of adequacy of world supplies. And if what we anticipate doesn't come through, then the underlying fundamentals are there to give a strong resurgence in prices. I'm not cheering for that. I'm just saying there's a risk of that. So soybean markets, Guy, I'll put this up, make a few comments, and then turn it over to you. Market anticipates record large Brazilian 23 soybean crop. And I've read this morning that crop's 95% harvested. So it's coming. It's a matter of getting it to the ports, offsetting most of the historic short soybean crop in Argentina. China's preference, this is Dan O'Brien comment, China's preference to import non-US soybeans and other oil seeds if they're available. A negative impact on US soybean exports, although we've had surely a decent pace of soybean exports. And 23-24 oilseed market questions, US and South American planted area and production 23 plus, and the next 3 to 5 years, US and global renewable diesel production trends. It's mainly a US issue, but it's not out of the realm of possibility that global renewable diesel trends could move to the positive as well. Guy?
Yeah, just I guess my comments, not only for soybeans, record crop in soybeans, but we're also seeing record canola rapeseed production at 87 million metric tons. Also record palm oil production, which most of that production comes out of Malaysia and Indonesia at 78 million metric tons. So that whole oilseed complex has been responding to these higher prices. That said, we are seeing record demand for that as well, and we'll drill down into that as we move forward here.
Note again, similar situation in terms of a lack of volatility that we've seen in the soybean markets. These are weekly soybean closing futures prices. And again, from coming through a time of great ups and downs, and particularly in 22 with the Ukraine-Russia war, it seems that we're particularly with the Brazilian crop coming on as it is, that's been enough to hold down our worries, even in the face of what's happened with Argentina. not a lot of volatility coming in these markets, have generally drifted lower. World stocks to use, current 22-23 at 103 million metric tons. And that has the latest. I always have to make sure I'm getting the right marketing year. That has the 22-23 marketing year has the Brazilian crop in it. So and the lower Argentine crop. So even with that, we're at pretty tight stocks to use, and that's with the strong record Brazilian number. World minus China, soybean situation. Again, if anything, it looks we've been whereas the ending stocks 100 million have been at just about where we've been the last 3 years. We went from 69, 68, 65. We're tightening up even with that situation. If we'd had a good Argentine crop, well, maybe we'd have seen some growth, but we haven't this year. And because of that, you're at a 9-year low percent stocks to use, 65 million metric tons for ending stocks for soybeans. If you look at a world less China perspective. Guy, I want to put up here the world exporters last 3 full years and then this year. Any comments on this?
Yeah, look, just right now we're seeing the shift from U.S. suppliers of soybeans down to Brazil. As you said, they're pretty much through their harvest down there, so that supplies become readily available. There was some concern last week with some labor action on the South American ports, but that seems to have been resolved. And so we're transitioning to that second half of the year with the logistics where South America is becoming the primary supplier of that. So I've had some conversations and concern, with Brazil's increase in the exports and the dominance. Does this really bother the fact that U.S. is losing market share in the export markets? For me, that really doesn't bother me too much at all. A matter of fact, we're still increasing the production of soybeans in the U.S. We're also seeing significant increase in domestic demand and consumption, particularly driven by the biodiesel situation on that, and that actually is stronger for the economy, and the fact that we're increasing domestic usage of soybean oil and soybean meal in that. We're still a third of the world soybean and oilseed supply, and we're going to continue to be a significant price influence in that, even though we're losing a bit of market share.
Driven by available crop size, really.
Yes.
And note on the import buyers, China predominant, about the same amount of just about the same percentage of the last 3 complete years versus where we're at. European Union, not far different. So a lot of stability there. Note that Argentina is the 3rd largest importer of soybeans this year. I'm sure most of that came from Brazil, just in trying to deal with their drought situation.
Well, we could see Brazil supply up to half of Argentine's domestic crush capacity down there. Good thing Brazil's having a record soybean crop, and it'll be interesting to see how that moves logistically into both Paraguay and Argentina.
Yeah, 8.3 million metric tons for Argentina this year, and over the last 3 complete, 4.5 average. So some of what we've been talking about seems to be revealing itself. I don't know. We've talked on this a lot. This is a way graphically to look at Brazil production, Argentine production. The green lines, again, shooting strongly upward on Brazil, up to 154 million metric tons. Argentina dropping off sharply, and reports in country of that dropping, 3-4 million metric tons, even more. So just a tight situation in Argentina.
Yeah.
Guy?
The interesting situation is Argentina, with the introduction now of the soy dollar down there, the need for the Argentine government to generate hard currency, and their willingness. It sounds almost like they're going to make that program of paying the Argentine soybean producer, particularly, but even other commodities, a bit of a premium on the exchange rate to encourage them to move that sell that commodity and particularly move it into export markets as that country tries to secure hard currency. They're experiencing 100% inflation in Argentina. Argentines are usually pretty good at understanding how to manage inflation. They do that by holding ag commodities particularly and matching up their sales with their input purchases. But it's 100% inflation, significantly higher than what it has been. And it's just not a good economic environment in Argentina.
China soybeans, Japan soybeans. There's Japan's is one of the major buyers of soybeans in the world in export markets, but you just see the overpowering quantities of China's involvement in this. Their imports, again, 99, the last several years, 99, 100, 92, 96, projected recovery. You can see some of their domestic crush. So I don't know what to think on this guy. I think you have some comments on the livestock.
We've sort of bounced off that 100 million metric ton level there for China soybean imports. The big advent 2 years ago was the occurrence of African swine fever, and it just devastated the Chinese swine herd. That started to recover, and it's back up to more nominal levels. That said, we have seen a shift in, I think, the consumer consumption to poultry consumption rather than pork so much. But pork continues to be and will always continue to be a big portion in that Chinese diet. We've also seen good increases in beef demand into China, and that bodes well for U.S. and Australia, particularly, as they're big suppliers in that, and we're seeing that diet shift. The beef is a bit more residual. It just didn't see that drop that we saw, particularly in pork and as well as poultry when prices went up, which is a good thing. So we'll hopefully continue to see some meat imports into China there. But I think this recovery in the domestic crush is being driven by the recovery in the swine herd.
Comments, Guy, on the world soybean meal, soybean oil?
Yeah, I guess the one issue, China's the big driver on that, but the one issue that we haven't talked about is the demand for biofuels and vegetable oils position in that. There's always a lot of talk and concern that what are we going to do with the surplus meal with now that we're crushing for oil. And this isn't just in the U.S., but in Europe and potentially other places as well, as we continue to grow that demand from the energy sector in there. One, with the higher interest rates, I don't know if all this increased capacity in the crush is actually going to get built. I think it's going to be rationalized a bit from what we saw projections 12 months ago. That said, I'm increasingly optimistic we're not going to have this glut of meal, or meal will continue to price itself into the livestock and the feed situation. And we've seen that. We really haven't seen a drop in soybean meal prices like some have expected, even with a growing crush driven by the bioenergy situation.
Let's take a look at wheat markets in the time we have left. Key trends. Guy, historically tight world ending stocks, the tightest of the commodities we're looking at. Stocks to use in current market years 22-23 should be. I got a misprint there. Will supply demand balances rebuild in new crop 23-24? If Ukraine/Russia trade agreements, and I put that way, in that Ukraine is a player in this, but again, Russia has such a dependent say in what's actually happening. They're on again, off again, and as Antonina, as you discussed, adding geopolitical swing factors into global wheat markets. And that's the politest phrase I could come up with to say how this comes into play. One thing sure seems to be the case, though, is that the wheat market traders go up. Their sentiments go higher or lower based on whether that a Ukraine trade arrangement is functional or not. So, and there's anticipation of 22-23 El Nino weather impacts. in Australia, North America, Europe, Black Sea, and elsewhere. Guy, I know you worked in Australia and have some pretty strong opinions on El Nino impacts there.
Yeah. Well, I just, think rain makes grain, particularly in Australia, and I think we're going to see them come off their record grain production. When I sort of look at this world wheat situation, we've seen record production again this year, but we're still seeing demand outstrip production, and we're going to see ending stocks can continue to drop on that. So, and as I've said for some time, wheat's got to stay priced out of the feed grain ration, and we saw a record high corn wheat spread just in the last week in the Chicago markets, as they're clearly signaling that wheat can't be a feed grain. And if you're a hard red winter wheat producer in Kansas, traditionally that first quarter we've seen a noted volume of wheat go into the feed ration. It'll be interesting to see how much or how little of that moves that direction this year, particularly in the wake of smaller production.
In light of all that, still, this is hard red winter wheat futures charts weekly. Has been anemic to moving lower. Not much in the way of strong exports at all. Again, the U.S. dollar has something to do with that. Has a lot to do with that. And you can see current levels, not a lot of volatility, really. Again, not compared to what we had seen. So this is the mode we're in. Where we'll move. We're in the at these levels, we move 10, 20 cents a day, and it doesn't shake us up. So it's interesting to watch the narrative attitude of the wheat market and how it plays out. And just to show you quickly, then here for world wheat, we're at 8-year lows in terms of percent stocks to use on the world side. And as you say, Guy, strong production, but usage keeping up just as well, if not higher. World less China, we're at 15-year lows for stocks to use in this current marketing year versus the last marketing year. We haven't been to 125 since way back in 2007, 2008. So it's a tight situation that we're in. You can see the world less China stocks to use figure 19.3%. And again, not that low since back in 2007, 2008. So we're in a tight situation. And you do see that how much wheat stocks are claimed to be there for China. And Guy, I know it's a broken record, but when we bring this one up, but do you have any thoughts on the wheat stocks figure there in China?
Look, the corn stocks, I think the market's pretty much figuring it's around 40 million metric tons, less than 50. But it's interesting, China is now the world's biggest wheat importer, as per the USDA last month, sort of confirmed that. The question in the stocks that China is holding is probably the biggest question mark hanging over the market. It's hard to get any information on that out of China, food security issues. I'd suggest the stocks held by China are probably not the best quality. And I know some of them in the last 12 months have been increasingly fed. But again, there is a level they're going to keep that inventory at. Generally, it's probably, you'd like to think, 1 year's of usage or demand domestically. But you're seeing China continue to engage that wheat market in a more aggressive way, particularly on the quality end of wheat. We see it for the white wheats off the P&W out of Australia, for even the higher protein bread wheats coming out of Kansas, and the spring wheats, which tells me they're putting that into the bread market over there.
And let's kind of move quickly through these since we're running long, you and I. World wheat exporting countries versus the last 3 complete years versus the one that we're in. And you sure see Antonina, this comes back to your some of what you talked about. Your Russia, in terms of wheat exports, 35.5 million metric tons, a 3-year average. This year, 45. Ukraine, 18.9 million metric tons, 3-year average. Last 14.5 on this one. You've got some other movers and shakers, things happening. Australia, 20.1 million metric tons, 10% of the world's wheat exports last 3 years. This year, coming off a tremendous production year up to 28. Guy, any comments?
No, I just we've seen the recovery in the Canadian drought there, and Australia move up on the back of rainfall. So really no surprises in the export matrix.
And there are just so many players on the world import side. Guy, you noted something here about China in particular.
Yeah, well, China's moved up from what were they, number 4 last on the 3-year average to number 1 as the world wheat importer at 12 million metric tons. I think that trend will continue. China's issue is water availability, and they just need to decide what they're going to produce with their limited resources. But I think they're going to increasingly be a growing participant in that wheat market.
Just hit some. I think we've already talked about the Ukraine wheat situation. You can see the fall off in that and how their exports have come into play as opposed to the Russia situation, how they've jumped up in terms of production, the official production number, and how the exports have jumped. And we've already talked on this quite a bit. Canada, Argentina, the drought in Argentina affected wheat as well. And so you can see a real drop off in their exports from a range of 11 to 11.5 to 13.8. Most years, 16 million metric tons a year before, down to 5.5. So that's been in play. European Union wheat. I wanted to bring this up, particularly Guy, for the Australian wheat supply demand trends. You can sure see the impact of seemingly of La Nina in Argentina, in Australia, bringing in the higher numbers.
Yeah. No, definitely a recovery there. One thing you can count on in Australia, in 6 to 8 years, they'll have a major drought through there, and we'll be back to 2017, 18, 19 levels on that. So it's either feast or famine down there.
It's a feast or famine deal, isn't it?
At the moment, it's looking pretty good.
And Guy, I look at these numbers for China. We're just about done here. So they have domestic use over the last 3 marketing years, 155, 148, 146, generally going lower. Production trending slightly higher. Stocks moving generally up. Generally sideways. Production moving higher, but yet their purchases of imports have been moving higher. To me, you try to put that together, and I think from what you've said, this is probably a wheat quality issue, isn't it?
Well, it's a quality issue. One, it doesn't surprise me they want to have their carryover reserves sort of equal to a year's usage. That fits with their food security approach, particularly as I think they're opening up that feed grains market for livestock production. That's sort of where soybeans were 25 years ago. I think they strategically now have to make the decision that where are they going to get their animal protein from? And I'd suggest their preference is to produce the animals in China, not import the meat, but import the grain. So I think that corn market will continue to open up a bit. But I think they want to maintain that food security interest of rice and wheat at a significant percentage of annual usage. But that said, there does continue to be good growth in demand for European type breads, and that means they're going to import U.S. and European type wheats, as well as some varieties of Australia wheats there as well.
So, Guy, we're tight on time, and I put us here by talking too much. But you've got in the handouts you have a number of countries listed at risk. Do you want to talk about this?
Yeah, look, we've talked about the Ukraine. I just think we need to keep that whole European situation in context. Germany's facing some significant economic strain in their manufacturing, and particularly coming from the energy sector. Just need to keep an eye on that, how they're going to react. The UK, they're still out there post-Brexit, trying to figure out where they're at. They need to establish some trade relationships, and they've failed to do that. I thought they would have secured something with the U.S. I think maybe the current administration, U.S., isn't quite as keen to lock in these trade agreements as previous. Just keep an eye on that. On the Middle East situation, these countries sort of worry me the most from a commodity perspective. Turkey is a significant importer of wheat, particularly from the Ukraine and Russia. They process a lot of that and re-export that as finished food or pasta flour situation. They're starting to experience some domestic economic stress. They have 50% inflation at the moment or more. I think the current president's not going to get reelected, so we'll see how they sort of manage through that. They're also a NATO member on that. Africa is always a bit of a concern, particularly with civil outbreak in Sudan. South Africa is the key country down there, as they're a major producer of food. Zimbabwe has that capacity, but they're experiencing, I guess, increasing economic and domestic strife there.
And then
Asia,
finally, I think,
yeah, Pakistan's usually a major importer of ag commodities, and their currency sort of collapsed here recently, similar to what happened in Sri Lanka, and that is a concern. Hopefully they'll work through that and put themselves back on a stronger footing, but that disruption in Pakistan is a concern.
and in the Americas, finally.
Well,
Oops.
Venezuela and Argentina. Venezuela's been there for some time. Argentina's currency, they've got over 100% inflation now. The Argentines seem to know how to manage through that, so I wouldn't necessarily they're at risk, but it is impacting their export flow and their capacity to buy in higher cost inputs to produce agricultural commodities.
PC stands for personal consumption.
Per capita consumption.
Per
So it's
capita,
GDP on a per capita consumption basis, and then the other number that's frequently in there is their inflation rate.
Okay. Well, thank you very much. Stop share here. Thank you, folks, for your patience. We just, a guy and I had a bunch of things we were really interested in talking about. So I hope for those of you that are still here, that's been worth your while. So Rich, turn it back to you.
Thanks, Dan. We did have one quick question earlier. He notes that the CME May wheat futures are now at a discount to the CME May corn. Do you have any comments on that? The Chicago, that'd be Chicago.
Right.
May
So
future,
generally soft red winter, although I think you can deliver almost all classes against that, unless they've changed that against that Chicago contract.
Yeah, we're in delivery. I wouldn't necessarily take a lot of notice of that. I've been looking at the new crop July for a while. We're in the delivery month the end of the week. So
delivery is just around the corner. So we're not worried about soft red winter production prospects at this time. And on the corn side, I guess, to be honest, I don't want to just throw something out there. I need to look at that more. Although it's probably more concerned about the soft red versus the hard red contract. And I think that I don't have the futures right in front of me. If someone does, that we have hard red's had a pretty strong premium against soft red, and that's indicative of the tough production prospects out here.